The market has opened and we're seeing pretty much red right across the board, although we do notice Nvidia up 2.2%, making new all-time highs. And when we take a look at the overall market, as we can clearly see shown by the red, the forward P of companies are looking to hit all-time highs, making us a bit wary of buying these companies at such extreme valuations. Now today we're running through 10 companies trading towards their 52-week lows. Are they a buy? Should we consider them in our undervalued portfolio? Let's jump straight in. The first one today, the Estee Lauder company, and it's down 35% over the last 12 months. If you've been a shareholder over the last 10 years, not great at all, 19%. Even if you include dividends reinvested, it would still have significantly underperformed the S&P. And we can see all-time highs, December 2021, $370. It has come down quite some way since. Right now though, trading towards its 52-week lows, we get a double buy rating seeking alpha in Wall Street, although we do notice quant believe this to be a sell, and we can see the forward yield sitting at 2.93% and the forward P right now at around 31. Now in terms of looking at their earnings over the next 4 quarters, they are anticipating 3 of them to be growth. However, the more recent quarter, the upcoming one in Q1 2025, they're anticipating a drop of 14% year on year. What I do quite like is that over the previous 4 quarters, management have smashed their targets, as we can see quite strongly. That is a 100% track record, giving us faith that June 2026, their next full year account, they will be able to hit that target, lowering the forward PE down to a significantly more reasonable 22.61. Now, in terms of this company, we'll look at them all very quickly. Their dividend safety score sits at 40 unsafe. As always, if you want us to do a deeper dive on these companies, do let us know and we can check them out. Dividend yield theory, well, this is showing a sign of massive undervaluation. The yield's significantly higher than the 5-year average, although we do have to point out they haven't increased that dividend since November 2022. Now we're going to, for each one of these, get into the valuation, and as we can see in today's episode, Estee Lauder coming at $109. When we do our in-depth deep dives, we do run through the inputs and outputs of each model. Today we're getting straight to it. 109 with a margin of safety, always starting at 10%. We want to use this where we would execute if it meets the 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that for EL, well, a buy up to $98.52. Then we keep going till it's near the current trading price. And what we can see in today's episode, you're not getting a 20% MOS just yet at $88. We can see though you are getting a 15% margin of safety. With Wall Street, they are still bullish on this company. They have a price target of $107 over the next year, indicating 19% upside. So is that sufficient as we go across these 10 stocks a day? Is the MOS and the upside one to consider in the portfolio? As we said, Estee Lauder, 15% margin of safety with 19% upside over the course of the year. We also want to let you know we've just released our latest free weekly article. As always, we drop one every single Monday morning to your inbox, where we talk about what's happened in the market over the last week, as well as undervalued stocks that we do believe deserve your attention. So go click on the pinned comment below, sign up, and you can read these straight away. You will also be able to gain access to 36 undervalued stocks for the month of October that we do believe necessary for your consideration. Lots of information. We also see what Wall Street say in terms of the upside over the next year, and we flag those that sit within our own portfolio for those that are interested. And for this month as well, you can grab a copy of 22 undervalued stocks that Wall Street themselves believe have the most upside out of the whole S&P 500. As we said, click on the pinned comment below where you can sign up and read straight away. We then move on to Devon Energy with a double buy rating and a hold from quant. As we can see, trading towards the 52-week low, a forward yield sitting just below 5%, a forward PE sitting below 8. But although we do notice over the last 12 months, it is down around 15%. Over the last 10 years, down around 33%, but as always will depend at which point you did buy shares. As we can see, for those that bought at the COVID lows of $6, you would be up significantly, in fact nearly a 7x from that point. In terms of their earnings, well, out of the next 4 quarters, as we can clearly see, 3 of them they're anticipating double-digit decrease to the EPS year on year. What is good to note though, in terms of management, their forecasting does look to be very good, as they did outperform their targets 100% over the last 4 quarters, and we can also see nonetheless they're expecting a small increase to the EPS, lowering the forward PE to 7.69. In terms of dividend safety, sitting at 41, borderline safe. Dividend yield theory showing us reasonable valuation, and based on the forward PE, again we can see that reasonable valuation signal. We do point out though they did decrease the dividend over the last full year. However, when we take a look at the valuation, firstly, Wall Street very bullish. They have a price target of $55 with upside of 36%. Remember, you are getting a nice yield whilst you are waiting, and we can see the intrinsic value of $59 in today's episode does give us a nice MOS. 10% a buy up to $53, and as we keep going in today's episode, we do notice you are getting quite a large MOS, at least 30% up to $41, and for those wanting 35, you would need to wait $38.50. So Devon Energy, is it a buy? Is it one of those that you need to think about the longer term, so you are getting that long-term gain if you believe this company will outperform? So is this a company to consider in the portfolio? You are getting a very strong yield, whilst Wall Street remaining very bullish on this company, as we can see a 36% upside. As always though, do give us your thoughts as we go through them today. We then move on to the Hershey Company, first time today with a triple hold rating across the board, trading towards the lower end of the 52-week range. We see a yield just below 3%, a forward P sitting below 20, S&P for context around 24. Over the last 12 months, well, down 3%. Over the last 10 years, up around 98%, and we can see it has pretty much come down from the peak in May last year at $275 due to the rise in the cocoa prices. However, we are seeing that start to fall. Remember, that does make up a significant amount of their cost of sales, and hopefully in the long term we can see that come down and Hershey can become a lot more profitable. In terms of the next 4 quarters, 3 of them growth, so 75%, nice to see. However, they missed their more recent quarter quite substantially, and if you do look back, the previous 3, they were a beat. So 75% track record, and important here to understand, they're expecting the next earnings per share for December 2025 to be a decrease, hence why we see here a forward P increase of 20.31. The dividend does look to be safe with a score of 80, massive undervaluation signal on both the yield as well as the forward P, and very nice to note they did increase the dividend double-digit rate 15% in February this year, something they have done on a consistent basis. Now our intrinsic value, $211, margin of safety at 10%, a buy at 190, at 15% isn't quite there yet, so Hershey Company sitting between a 10 to 15% MOS, and we do notice Wall Street, who did give this a hold sign, only believe there's around 10% upside over the next year, taking this price to $205. As always, remember you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for the Hershey Company or any others. Continuing on, we have the Nestle Company with a double buy rating from Seeking Alpha and Wall Street, a hold from Quant. It does have a nice yield, 3.31%, a forward P at 18.5, trading towards the lower end of the 52-week range, in fact $3 shy. Down 12% over the last 12 months, and over the last 10 years up around 39%, as we can see all-time high back end of 2021 at $140. Now in terms of moving forwards, they are pretty much expecting their earnings per share to be flat from the previous year, with very minimal movement to their top line revenue, as we can see around $2 billion growth, that is under 2% over the previous year. Then we look at their dividend safety, first one today with 99, the highest score obtainable with the very safe sign. Undervaluation on the yield, in fact the highest yield it's offered over the last 5 years. Massive undervaluation based on the forward PE. However, we do note here a very mediocre increase to the dividend in 2024. In fact, that is lower than the inflation rate that we always talk about at 4% on this channel. In terms of intrinsic value, well, our price 122, not dissimilar from Wall Street's 120, where they see 20% over the next year. When we look at margin of safety, well, it has more than 10% in today's episode. You are looking at not a 20% just yet, but sitting in between 15 to 20%, Is this one you're looking for your portfolio? Are you looking for exposure to this industry? Or for whatever reason it doesn't fit, do let us know. We then move on to UPS, which has been pretty much hammered for what seems like an eternity. We have a buy rating from Wall Street, a hold from Seeking Alpha and Quant. It does have one of the more attractive yields today at 4.8%, a forward P of 18.7, as we can see trading towards the lower end of the 52-week range. Down 13% over the last year. Over the last 10 years, up 33%, although it still hasn't recovered from the all-time highs, as we can see, beginning of January 22 at $224. Now, over the next 4 quarters, we notice growth to the earnings per share. In fact, from 2025, they're expecting strong double-digit growth, and the previous 4 quarters, very similar to another company we just reviewed, they missed quite substantially in quarter 2, their more recent one. However, the previous 3, we do see they have beaten 75% track record. We also note that growth is anticipated over the next full year, bringing that forward P down to 15.3. Now, dividend safety score sitting at 69, massive undervaluation on dividend yield theory, reasonable valuation on the forward P, and another very similar mediocre increase at 0.6% in January 2024. Now, our intrinsic value pretty much spot on with Wall Street, where they only see 10% upside over the next year. And when we look at our margin of safety, probably the smallest today for United Parcel Services, we're saying a 10% margin of safety, 10% upside, so maybe not one that you would consider at this point in time. With a 15% MOS, a buy around 126, and at the 20% level around 119. As we said though, 10% MOS and 10% upside. We then move on to one of Warren Buffett's big bets. It is Occidental Petroleum, similar to Hershey, a triple hold across the board, trading at its 52-week low with a yield of 1.7%, pretty much one of the lower ends in this oil and gas industry. In terms of the forward P, 15.6, and we notice it has been hammered 22% over the last year. Over the last 10 years, down 42%, although as we've seen with other companies, if you did buy it towards the COVID lows, you would have made some very, very large returns. In terms of the next 4 quarters, well, 50% or 2 out of the next 4 they're anticipating growth, massive decrease in Q3 at 33% year on year. However, management, as we can see, good forecasters, they have outperformed over the last 4 quarters, and growth is anticipated in December 2025's annual report, lowering the forward P to 13.68. In terms of dividend safety, we do see a 60 borderline safe score. We have reasonable valuation with an overvaluation based on the forward P. Nice to note they have increased that dividend at a double-digit rate last December, but as we have seen in the past, they are a company that have previously cut the dividend. In terms of the valuation for Occidental Petroleum, well, a 10% margin of safety would indicate a buy at $66, at 15% around $62, and in today's episode for this company, you aren't quite getting a 30% level just yet, sitting between 20 to 30%, with Wall Street very bullish, their upside target $70 with 35% over the next year. So it does look like one to consider if this is an industry that maybe you don't have exposure to, or even maybe just one to consider. We then move on to the railroad industry. It is Canadian National Railway Company with just a buy from Seeking Alpha, trading towards the lower end of the 52-week range, a forward yield of 2.16%, a forward P of 21.2, up 7% over the last year. Over the last 10 years, it is up only 65%. We can see all-time highs around $136 more than 2 years ago. In terms of EPS, they're expecting growth for all 4 quarters coming up. However, they have missed 2 of the last 4, with the more recent one in Q2 being a 7-cent miss. Nonetheless, December 2025 growth is anticipated to bring the forward P down to 18.72. Nice to note, another very safe dividend score of 97, undervalued based on dividend yield theory, undervalued based on the forward P, with a nice 7% increase to the dividend in January this year. In terms of our intrinsic value at $133, 10% MOS, a buy at 120, at 15%, pretty much where we see this company right now. It could be one to consider. For those wanting 20%, well, a buy at 106, but as we can see, today's episode for CNI, 15% MOS with 12% upside, Wall Street predicting $127 over the next year. We then have our first REIT today, Real Estate Investment Trust, Rexford Industrial, where we have a double buy rating from Seeking Alpha and Wall Street, a hold from Quant, and when we have done a deep dive on this, the metrics do look very promising. We can see trading towards its 52-week low, a yield of 3.63%, a P to FFO below 20, price to funds from operation. Over the last year, down 2%. Over the last 10 years, though, it has outperformed the S&P, up 206%. Nice to report, next 4 quarters all expecting growth, and the previous 4, at a bare minimum, it has been in line with management targets. Now they are expecting FFO, funds from operation, to increase over the next year, lowering the P to FFO to 17.82. We also get another very safe dividend score, massive undervaluation, both based on the yield as well as the forward P to FFO, with a very nice 9.9% increase to the dividend this year. We then get to the intrinsic value at $61, meaning there is a nice MOS today for what we do think is a quality REIT. At 20%, a buy at 48.51. At 25%, still meaning a nice margin of safety in today's episode, with Wall Street indicating 29% upside. Definitely one we would consider if you want exposure to the REIT. Maybe if you don't want to look at, say, VNQ, which is an ETF covering a lot of real estate investment trusts. This is one definitely to take a closer eye. 25% MOS with 29% upside. We then move on to STM Microelectronics with a double buy rating, in fact 4.46, nearly a strong buy from Wall Street with a sell from Quant, trading pretty much right at its 52-week low, a yield of 1.18%, a forward P of 16.7. Now it is down 34%. This is a fairly cyclical industry. Over the last 10 years, however, it has outperformed the S&P, up 292%. As we can see, cyclicality coming straight through those numbers. Over the last 4 quarters as well, they have beaten 3 of 4, 75% track record, with a nice increase to the overall EPS anticipated in December 2025, lowering the forward P to 12.48. Now, we don't have a dividend score for this company just yet, but we do notice they increased that dividend by 50% just over the last full year. In terms of our valuation, well, $41, not dissimilar from Wall Street's 42, where they see 50% upside over the next year. And when we run it through the calculations, as we can see, quite a large MOS at 30% is where this company is sitting at right now. But given the cyclicality, this may be a MOS that you need a little bit more, or maybe this is just about right. As we can see, 30% MOS, 50% upside from Wall Street over the next year. We then move on to LVMH, the luxury goods conglomerate, with a buy from Seeking Alpha, trading right there towards its 52-week low, with a forward yield of 1.76%, a P of 22.6. Now, over the last year, it is down around 5%. Over the last 10 years, it has massively outperformed the S&P, up 312%, although we do know pretty much all-time highs around the $1,000 mark is where it's sat right now, trading quite some way away. In terms of the future projections, over the next full year, they are anticipating around a 5% increase to their top line revenue, and this is a company that has historically increased their dividend at a very, very attractive double-digit rate. When we look at the value of LVMH, well, our intrinsic price, 914, does again give a nice MOS, 10% a buy at 822, at 20% at 731, and in today's episode, not at the 30% level just yet, you are getting at least 25%. With Wall Street, as we can see, they believe there is some nice upside over the next year, $850 price target with 27% upside. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to click on the pinned comment below where you can sign up to the free weekly newsletter and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.